FundsUpermart.com.
With interest rates at persistently low levels, how will this impact fixed income in 2012?
We're cautiously optimistic about the outcomes for 2012. Obviously, interest rates are very low, and this potentially could have negative impacts if interest rates were to rise globally. But on the other side of that, we've also got credit spreads and credit markets offering very nice, attractive returns. So we're seeing a nice balance, if you like, between the potential downside of rate rises, which would be in an environment where the economy's globally picked up. We'd see a nice offset there from credit and credit performing well. So we're optimistic that markets in 2012 should be able to earn the yields they're currently earning now and the types of coupons that we're currently seeing.
Within fixed income, what are some of the factors that could support performance?
Well, certainly at the moment markets are priced for fairly dire outcomes, particularly out of Europe. So there's a lot of concern around what Europe might do and the outcomes that we might see, and the flow-through effects we might see that on broader economies, and particularly exporting type economies. So if we were to see a resolution to a lot of those problems, or at least a movement towards a resolution, then I think we could easily see markets start to price in far more optimistic outcomes. And that again would see broader markets performing reasonably well as the markets and economies started to get back on track.
What are the risks fixed income investors should take note of?
The immediate risk is obviously Europe and concerns with Europe and what might happen there, particularly around Greece. We're of the view that the Greece issue will be solved at some stage. It's taking a lot longer than we'd hoped, but we're optimistic that Greece will be solved and that Europe will eventually come out of the malaise they're in. Longer term, investors in fixed income always have to be worried about inflation, because inflation eats away at fixed coupons. So we're very carefully looking at portfolios, looking at and assessing inflation risks and trying to build portfolios to protect investors if we see inflation start to rear its ugly head as economies start to improve.
With growing interest in the Asian fixed income space, what's the most or least attractive opportunity you see at the moment?
Well, certainly Asian markets have performed incredibly well over the last 10 years. And for very good reason. There's been, compared to global peers, balance sheets have been run well, leverage is low, and economic growth has been strong. So there's been a lot of really strong fundamental support for Asian bond markets, and we see that broad support continuing. Within the region, however, there are some conflicting drivers. We're a little bit cautious on Indian banks at the moment. We're seeing non-performing loans starting to rise in a lot of those banks as a result of some fairly incredibly rapid lending growth. So we've got some caution there, and Korea, there are some supply risks from the banks there as well. We do like a lot of the state-owned enterprises, particularly the Chinese ones and Hong Kong corporates. Within the high yield space, which is again a much smaller element and smaller part of the market, we prefer at the moment the Chinese property companies to the Chinese industrials. So there are certainly some opportunities there. Broadly positive, but there's a few pieces there that we need to be cautious of.